I'm sorry?
You're on.
Okay. My name is Jack Hedaya, one of the founders and principals of the Hedaya Capital Group. Welcome to the Future of Retail, the first of a four-part series that will address some of the major transitions, challenges, and opportunities that are going on in the consumer product space. Future webinars will deal with logistics, branding, and cybersecurity. Hedaya Capital was founded in 2003 by the Hedaya family as a spot factor. Over the years, we have continued to broaden our service offerings and now provide complete factoring services, advances, credit protection, collections, asset-based lending, trade and PO financing facilities, and inventory facilities for online merchants. We focus on early stage and rapidly growing companies doing sales between $500,000 and $100 million annually in the consumer product space, as well as industrial manufacturing or commercial services. We believe in partnering with our clients and working very closely to help them meet their goals. All clients have direct access to the principals and the decision makers at our firm. I want to thank our partners that have made this event possible: Triangle Capital, Riverbend Consulting, Project Retail, and RCS Professional Services. Thank you for joining us for the first segment of our educational series. Erwin Dayan, Vice President of Business Development and Marketing at Hedaya Capital, will be moderating the panel today. So with that, I'll hand things off to Erwin. Thank you, everybody.
Great. Thanks, Jack. Thanks for the intro. Excited to do this Future of Retail today. We should be covering a lot of what's going on in the world. As we know, it is changing every day. I'm happy to be announcing my new journey with Hedaya Capital. To let the people out there know that we'll be doing a lot of creative financing in the world of moving merchandise in every way, through stores, online, and every other way you could possibly move it in the future, maybe through Jetsons, maybe through who knows what going forward. The panel that I have today, a group of guys that I know for a long time. They cover their spaces incredible. I'd like to introduce the three of them, let them give you a little snapshot of what they do and who they are. I'll start with Richard Kestenbaum first. Go ahead, Richard, you're on.
Hi, good morning and good afternoon, wherever you are. My name is Richard Kestenbaum, and I'm a partner and co-founder of Triangle Capital. Our firm does mergers, acquisitions, and capital raising for consumer-related businesses. We have a lot of experience with companies that have high merchandising content and retail. And I also write a blog, which you can find on Forbes.com, where I cover retail and consumer issues and trends. Great to be here with you guys.
Great. Thanks for coming on, Richard. Next, Joe Zolka from Riverbend Consulting. So you're on, Joe.
Hi, everyone. Welcome. We're excited to have this discussion. I'm Joe from Riverbend. We work with third-party and vendor Amazon sellers, along with other online sellers to help them navigate through more of the most difficult things that are coming up in today's e-commerce world. And we have a lot of experience solving problems and dealing with things head on to put people in a position to succeed online. And hopefully in the future, something that I'm doing with Irv, the other panelist, to get people's products into retail.
Great. Thanks, Joe. And now Irving Safdie. You got your own show.
Hi, everyone. Nice to be here with you. My name is Irving Safdie. I am a co-founder and partner along with Joe in Project Retail. What we do is we bring the best of e-commerce to brick and mortar. We are finding a really interesting opportunity these days with the brands that have built themselves up online, both on Amazon and in other third-party marketplaces who have built strong brands, and now we're basically bringing them back into brick and mortar on the strength of the brands that they built.
Right. Interesting twist. Okay, so we'll start the questioning. I'm going to roll it around and move it around. One question we have, the first question on, why are stores doing so much less well than online? So I'll give that to Richard, because that was Richard's key point that he wanted to bring out. Go ahead.
Well, I think you said it right in rereading it. It's that they're doing less well. Why are stores suffering? Well, you know, the purpose of a store, the purpose of every store used to be the same. Stores had stuff, and if you want stuff, you had to go to the store. But now if you know exactly what you want, going to the store is less useful than it used to be. Stores have to adapt. Stores have to create a discovery experience that's worthwhile for the consumer. And stores have to create an environment that allows them to communicate the value of their brand. What consumers are looking for now in retail is when they're not going for replenishment and they don't know exactly what they want, they are looking not just for product, they are looking for identity and association. And that is a values-driven experience. Consumers used to find that they would want brands that supported their status, but now what they want is life values in their brands. And we're discovering it's an entirely new skill for a retailer to be able to convey life values in their stores. And that's why legacy brands are suffering as much as they are. The new direct-to-consumer brands have their values built into their foundation, and that creates association and identity that, especially on social media, word of mouth and sharing on social media causes the consumers to share their values with their friends. That creates a greater opportunity for the brands. That's very hard to do in a retail store, and that is the challenge for retailers now. Online is different, especially on Amazon, where there's so much activity taking place, where you know what you're looking for, and it's just a question of finding it. And so the purpose of a store has changed dramatically because of online, and the purpose of online has taken a lot of the strength and oomph that retailers used to have in their stores away.
Right. Okay, so the follow-up question on that, while you're on that is, will the products sold in stores change based on that whole conversation you just made?
Well, you know, a sweater is still a sweater and we all need sweaters. But the way in which you convey the value of your sweater is different. So if you know you just want a blue or black sweater and you need it for a trip or an event or something you're doing, you can buy that online or in a store. But if you want the sweater to be true to what you believe about how you want to live your life, you need to do some research, you need to go to social media, you need to talk to your friends. And if a store is done right, then you need to go to a store. So it depends on what you're looking for. What does that product mean to you? And that also affects what you're going to pay, because we all want to pay the lowest price. But where there is true identity, price is not first in how you choose your product.
Okay, great. Thanks, Richard. All right, I'm going to switch this over, I guess, to Irving and maybe Joe as well. But this is a question that a lot of people always ask me is that talk about in-person meetings versus virtual showrooms when selling retailers. How is the new dynamics of actually approaching a retailer to sell today? Are you flying to Arkansas, or are you Zooming, or do you set up a showroom? I know one of the clients that we have set up a virtual showroom that looks, sort of Star Wars type. So when Irving, when you're going to sell now, whoever that retailer is, what's your approach in the sell?
So it's been very interesting over the past year. It's pretty incredible how, tomorrow we have meetings that would have taken places in 3 different time zones happening in 30-minute blocks back to back to back. So the pandemic definitely brought in a new way of reaching the buyers. I find that the buyers, as of late, have had a little bit more time in their schedules because, it's much easier for them to set up like an open buy day where they're kind of going through new vendors back to back to back on the vetting to see what works. But ultimately, I think the expectation is over the next 6 months to 12 months, you're going to start to see these in-person meetings start to come about. We had a call just the other day with a major retailer, and we were talking about an e-commerce test. And then when we kind of said, oh, by the way, pre-pandemic, we were in your stomping grounds, once a month, their eyes kind of lit up and they said, oh, by the way, we plan to start that again in the next couple of months. And at that point, we set up an appointment. So I think what's really interesting about it is that it's been a lot easier to get appointments over the past year, in my opinion. And we've gotten a lot of appointments, retailers we didn't used to get appointments with. I think that really what's going to separate things in the future is whether or not you can actually convert that to an in-person meeting, and whether or not what you've established over that past year can really translate into, getting that face-to-face time. Because I think at the end of the day, what separates, the guys who are able to get the orders and not, are the people who are willing to commit that time, get in the face of the buyers, month after month, even if you're not getting the order, but to show that you're really committed to it. So I do think that we've seen a shift, but I do think that the time to shift back will be happening really by the end of the year, and if not early 2022.
Okay, great. So the next one's for Joe. What does it take from a branding and marketing perspective to build a viable and attractive brand for retail today? Because Richard mentioned something before, like legacy brands, a lot of these, what I call, I don't know, dust-off brands or orphan brands, they don't really play out anymore. So really, Joe, talk about the new brand today. I know that a while ago, Richard did a direct-to-consumer stuff for us, a webinar. So talk about the branding point, and then I'd love to see Richard and Irving jump in on it.
So the way I see things now is very different than, to me, what it was even 5-10 years ago, where it was more about product than it was about a brand. And I think now Richard nailed it, where it needs to be more of an experience, or it's an identity that someone wants to connect with, right? They want to, it used to be more about status and things like that. I don't think it's really about that anymore, at least from what I'm seeing from a shopping perspective. When retailers are looking for newness, they're looking for things that have followings, right? They want to jump on a hot trend. And sometimes those trends, especially in certain areas, can last a few years, right? So, I think if you're starting out, or even if you already have a brand that's been established, making sure that you're covering all the touch points from a customer's, kind of perspective of how they would find you and how they would connect with you, whether it be social media, whether it be a great interactive website, whether it be posting even on your website about the brand, about the meaning of the brand, about what it means to you as a founder. Richard and I spoke about this a few months back, how people want to be more engaged with the brand themselves, right? They want to feel like, they want to feel good about putting something on or buying something, or maybe it's helping a cause that they believe in. Politics over the last 2-3 years since, Trump and now Biden and all these, things that happened over the last 2 years, it woke a lot of people up that were sleeping for years. There was so much consistency with politics for a while, and it was like, okay, but now Gen Z is into it. Now millennials are into it, and all of a sudden everyone has such an opinion, where that wasn't the case years ago. So, finding a product or a brand that speaks to you is very important. But if there are not enough touch points, you're not going to connect with that brand. There's some really good brands that I think Richard was even involved in that did great Facebook and Instagram advertising over the last 2-3 years that really got big. And it wasn't because the product was great. Yes, the product is great, but a shoe is a shoe, a scarf is a scarf. These things are out there that, quality, okay, quality is important, don't get me wrong. Quality should be an automatic. Of course you have good quality. Of course you're making a good product. But how are you going to differentiate yourself to the end consumer? And the answer is a story. The answer is great touch points. The answer is content. So without those things, to me, don't even bother. Because the retailers want to see that, the end consumers want to see that. It has to tell a story. And that's what Irvin and I have seen also, because our story is, hey, this is a proven concept on Amazon, the biggest, marketplace in the world, where there's 50% of online shoppers are going to. This is your proof. There's 20,000 people that reviewed this product that said it's great. So, to me, without a story, it's very difficult these days. That's just my experience.
Right. So I want to lead that into a point. That was one of Richard's points, that when we discussed for today's seminar, how are Generation Z retail store customers different from boomer customers? So my thing, being a boomer, is it two tracks, Richard? Or do you take a merchandising standpoint is there such a thing as I'll buy a sweater and a 20-year-old will buy the same sweater? Or this is Irwin's sweater and that's somebody else's millennial sweater or whatever? Like, give me your feedback on that. I'm curious to know.
Well, there is overlap, and I think there's overlap for different reasons. So it's, we all know that younger is cool. And so how do you get younger consumers to buy something and make it cool for them and not let it get uncool when older consumers say, hey, that's cool, I want that, and wind up buying it. There are brands, and I won't mention names, where if you read the advertising, you'd think that everybody who buys it is 20 years old. But in reality, all the users of the product are mostly 55 years old, and they're only buying it because they perceive that it's worn by younger people when in fact it isn't. But I want to raise something else that's related. Joe was talking about product versus brand, and he's absolutely right. Product, is just as important as ever, as Joe was saying. You can't have anything that isn't, an excellent product. But now there's more. There's the values I was talking about before, and that is very hard for legacy retailers and brands because it feels inauthentic when they try and bolt values on to their existing marketing or presentation. And what we're finding, I want to add one more point to what I was saying before, because what we're finding is that the data is revealing that successful brands have not just cohorts of customers, but micro cohorts. And what I mean is, you're finding that with production and marketing being able to be targeted in very specific ways, we're seeing that successful direct-to-consumer brands wind up being bought by people who are very much alike, and they share certain demographics, not just age, but their attitudes towards certain things. It could be politics, but that's very big. Their attitude towards certain things and certain aspects of their demographics, like their incomes or their occupations or where they live, or the kinds of hobbies that they like, things that make it very micro, that allow them and their cohort to share not just values, but products that allow them to identify with each other. And that has an important aspect in how you market, because if you market widely, you're wasting a lot of money. If you can identify the cohort, then you can market just to them. And that makes the customer acquisition cost, which has become so astronomical and fatal for a lot of brands, to be effective when you can identify your cohort and it's narrow and deep.
Great.
Irwin, just want to jump on something that Richard said. He said
Sure.
Cost per acquisition, right? And yes, we're not always talking about online. We're not always talking about in store. But at the end of the day, if you're going to get someone to buy your product, you better make sure that they buy it more than once, right? They have to like it. They have to connect to it. They have to say, you know what, next time I'm going to buy, the other 3 colors, or I'm going to try another, product from this line. If you're relying on one sale, then you'll never be profitable, because the cost per acquisition will be close to 80–90% of the revenue. That's just how it is these days. There's no way around it. So just in a basic numbers game, if you were to try to get a customer to buy a $40 item, in advertising and marketing today, it may cost you $40, $50 to get that. If you're not going to keep them over the next 6 months to a year, that's a loss. That's a huge loss. So
one marketer I spoke with called that leaky boat syndrome, where you spend all your effort to, right? You know what it means as soon as you hear it.
Time out. I'm writing that down. I like that buzzword. Yeah, leaky boat. Okay. Go ahead.
You got to keep marketing to the same people, and it's so much less expensive, and you have so much less to teach them. You just need to remind them that you're there, and they'll come back.
And also something that Irvin and I have been seeing, and this is part of the pitches that we're doing when we're speaking to these brands that are trying to go to retail, is if you excite them with digital marketing material or content, they are still going to the stores, right? We all know the numbers. It's still 90% of shopping in the US, or maybe 85% is still done in store. So if you can excite them with an email blast, or you can excite them with a great post or something, or even a new product launch on Amazon or a marketplace, there's a very good chance that when they're in the store and they recognize the brand, they will pick it up. So all of this, it's a big circle, right? You're just trying to get them familiar with your brand and your product, so then when they do see it in store, they pick it up.
Okay, so that leads me to one of the questions that I originally had, which falls right into place here. Are there any new demands from buyers in today's climate? Maybe Joe and Irving could, in other words, what's now when you approach a buyer, where years ago, let's say they saw the merchant, they gave you PO, when you're shipping, have a nice day. What does it look like today?
So
Either
I
Joe
think
or Irving or both, please.
when it comes to the new demands from the buyer, it's been pretty consistent over the past few years, which is they want the validation before they're going to give you the shelf space. So whereas, probably before my time, it was probably a lot easier to get an order, but, over the past minimum 5 to 10 years, it's been, we want to do the e-com test, or we want to test you in the smallest way possible in store. Now it's moving towards we want to, drop ship you. So they're not even taking the actual ownership of the product. So they're really looking to reduce their level of risk as much as possible in order to kind of find the diamond in the rough. I think what's created a really unique opportunity for successful e-com sellers these days who are looking to make a splash in brick and mortar is that if they built that successful e-commerce traction, and particularly on a spot like Amazon, which I know a lot of people do have that placement there, it's very public, right? There's no secrets over there. And if you have a strong brand that has a ton of ratings, a lot of positive reviews, oftentimes what we're seeing lately is that the buyers are willing to forego those initial kind of gatekeeping questions because you already have a lot of that, why do you want to test 300 pieces on your site when I can show you that I have 50,000 positive reviews from all these customers on Amazon that you can go and validate yourself. So
Right.
I think that need for them to protect themselves and to make sure that they're getting the right ROI on their tests and they're making sure that they're only bringing in the right products, that need still remains. But now there are new ways to kind of circumvent that and maybe expedite that process and get that vendor numbers to the consumer.
Okay,
And I
great.
just want to piggyback on that, Erwin. That's definitely one way with Irv said about having the reviews and the brand, a strong brand on Amazon. But think of it this way also. If you're starting a business or if you're starting a brand and you're thinking about how do I market myself, what better way these days than to potentially align yourself with some influencers? Now, I'm not talking about Kendall Jenner, right? That takes $500,000 to wear
Why
something
not? Why
once.
not? Why not?
Well, because Erwin, we'll leave her to you. We'll leave
I'm
her to
joking,
you.
but I'm saying that would put you on the map. I mean, if
Of
Kylie Jenner
course.
sell $1 billion in lipstick or she smiles on an Instagram post, then I'm in the lipstick business.
Well, to address your question, Erwin, that's a lot of wasted marketing dollars because a lot of the people that the biggest influencers reach won't wind up buying your product because it's not in their market.
It's
I mean, the
too broad.
conversion is not there. Conversion
It's
is
too
not there.
broad. So what I'm saying is, when you're thinking about a marketing plan and you're going to roll it out, you want to go, like Richard said, hyper specific to your market, and that means doing a lot of research of who people are following and sending product to them. And the same way buyers will say, hey, your listings look great on Amazon, you have a lot of reviews. It's the exact same thing they'll say if they see your Facebook page or Instagram page. That is also validation. Hey, you have 25,000 followers and this influencer is promoting your product. So you're kind of, like Irv said, foregoing that test stage of validity that all of a sudden they believe in you. And a lot of the buyers are young and they're looking at these things even before they say hi to you. I know Irv and I, we were on a call. The person didn't look up into the screen for the first 10 minutes. Instead, he was on his phone looking to see, the social presence that the brand had, looking at Amazon, looking at Walmart, looking on Google to see if we came up. And then he said, oh, hey guys, as if like the meeting wouldn't have even happened if those things didn't check out. So it is it's a different approach than it used to be, where you can just make great product, and put it on a nice CAD and show them something shiny. You have to have the full gamut.
Okay, so my next question is one of Richard's, which I think leads into this, and I wanted to just sort of, ask a little further. Richard said, in the future, will stores be bigger or smaller? That was the point. But I'm reading into it a little more, saying if the stores are smaller, then you're fighting even tougher for shelf space. So what does that dynamic mean to the work? Do they cut out categories? What's your take on that, Richard? On the smaller
The
footprint?
reason why I debate that and raise it in our previous conversation, Erwin, is
Right.
almost every CEO of retail that I talk to says, in the future, we're going to have fewer stores and smaller stores. But we all know there's a lot of empty space, and there's a lot of landlords who need to do something with that space. And so I say to them, well, what if the landlord came to you and said, for the same amount you're paying now for your smaller stores, I'll give you a bigger store than you had before. What would you do with that space? And by the way, the reason that's so important is because what you do with that space will determine whether you can get consumers to come into your store. We talk about experience, but what does it mean? So, you look at, I always think of Las Vegas and Orlando as examples of it. Almost no one goes to those places to shop. When you ask them, what are you going to do in those places? They don't say shop. But you often see people in Orlando walking around with hats with mouse ears, and people buy Fendi bags in Las Vegas that they didn't expect to buy. So when they have a good experience, when they come to a place for an interesting reason that isn't because they need new toothpaste or something that's a replenishable, but they're just going to have a good experience, they wind up shopping. So what is the experience that you can give a consumer in a store? And we're starting to see examples of how that works. There's a store called Camp that brings families together for experiences. There's Alo Yoga, which has yoga studios, but you can't get to the studio without walking through the store, in the same way that you can't get through a theme park without going through the shops. So how does retail adapt to that? And how do we cause more shopping by making experience? And I think those are the kinds of challenges. And what's different about that now in the future, and will be in the future than it was in the past, is that every store used to be the same in that they had stuff and you came there to buy it. But now every store needs to have a different reason, and a reason that relates to its product to get you to come, whether you intend to shop or not. And that's risky, and it means new skills, and that's scary. And that makes retail a much more challenging business than it ever was in the past.
Right. Okay. So just to piggyback that statement, if you're saying that because there's a lot of space and landlords will be friendly to making a better deal financially, and maybe this new experiential or whatever you want to call it, driving the traffic in, leads to the next point, will retail store rents rebound? So if they start loading these stores up on a more favorable terms, do you see like all these stores in 2 or 3 years all jumping and all these stores are full again?
No. Look, the United States has had way more retail space by multiples of between 5 and 10 of any other country. The UK was next, and it wasn't close.
Right.
And we've overbuilt retail. A lot of malls are not going to exist, especially B and C malls, and that's where a lot of space will go away. But it's also true strips in downtown areas. And of course, online has become the tipping point of, well, if I need that to replenish my toothpaste, I don't have to go to the store, so I'm not going to go. And therefore, we need less retail space. So that's just reality. Almost every square foot of retail space in America is worth less than it was 24 and 36 months ago. Not every landlord has acknowledged that or adjusted to it, but they will, because economics always wins.
Right. Right. So then to finish that point on availability of space, are malls part of the future, only part of the past? That was your point also. So basically, you're saying there'll be like a shakeout, and then whatever malls are still hot, and the other ones will be housing or playgrounds or schools or apartments or.
Well, we're seeing a lot of conversion of malls to mixed-use communities of both commercial space, retail space, entertainment space, housing. And I think we'll see more of that. Not every retail mall is suitable to be converted that way, but those that are likely to be. I think you also have to distinguish between A malls and B and C malls. The B and C malls are the most likely to be converted, and the A malls are the most likely to survive.
Right.
So everything depends. Real estate, every square foot of real estate is unique, so it depends on what will happen there. But no, the price is not going to go up.
Right. Okay, so to the next topic, which I think is really, bullseye to me, it's sort of like the flip, like brick and mortar was a thing. E-commerce came from left field and became like the road runner. And then now it sort of flips. And the guys on the screen like Joey and Irving, how has e-commerce created brick and mortar opportunities for e-com native brands? So the three of you guys could jump in, but maybe Irving, your Project Retail, you want to go, and then Joey, and then Richard, because you're all in that space. And tell us how we flip this brick and mortar native brand online, back to the store, store to online. Where's it going?
Definitely. So I was in wholesale and I was servicing a part of the market about 7 years ago that pretty much disappeared. It's a specialty market. So Charlotte Russe, Route 21, those are all my big customers. And about 1 year, that whole market pretty much was decimated. And so at that point, I made I said I'm going to pivot to e-com. And that's what most of the people that I know, a lot of my contemporaries, they made that pivot as well. They said that, that's really where the future is. We don't really want to be playing at this part of the market. And, Walmarts and Targets are right now out of our range with the newer brands that we're kind of building up. So we went out to e-com. We started to build these businesses. And then, really, essentially, we weren't building our own direct-to-consumer sites. We were working in marketplaces. And at the end of the day, there was really one marketplace that mattered, right? You have like Amazon that's up here. You have like Walmart that's down here, which was the next one. So we built these Amazon-centric businesses. And really, the pandemic kind of threw things through a tailspin for myself and a lot of my contemporaries in that we were no longer allowed to ship in what we had brought into the States to support that business. And it put us in a very, very difficult situation because, I brought in 100,000 units. I'm only allowed to send in 20,000 now because they need Purell and Clorox. And what do? And at that point, I had no choice. I had to start picking up the phones again and start calling the retail buyers because I had a very dangerous situation on my hands. And what I found was the phone calls that I made last year versus the phone call that I made 10 years ago were received in a significantly different way because we had built up the brand online first, right? So we weren't some of the same brands as 10 years ago. There were new native brands that we built up. And now when we made these phone calls to these retailers that had never, ever picked up our phone calls before, they were starting to answer us. And they were starting to place orders. And it wasn't only e-com orders, it was store orders. And it happened to have been, because we were an e-commerce company and we had inventory on hand, all these wholesale companies that were depending on the cut-to-order stuff that was stuck in China, we had that other opportunity where we actually had inventory that we could sell. And it was kind of like these factors that kind of came together and created these opportunities where we were able to now play both sides of the market in a much stronger way than we had ever been able to do before. And so Joe and I, we had this conversation about a year ago or so. We said, how do we create these opportunities for these e-commerce brands that existed, but had no ability to sell into wholesale because they didn't have an experience? And we found that in a very similar way, like almost carbon copy one of another, those phone calls that we made were, hey, you're a great e-com brand. We know who you are. We'll take this phone call. We'll test you. And I think a great example is, we don't represent them, but that electronics brand Anker. Anker, they were a huge Amazon brand. And now you walk into Best Buy and you see their product on shelf, right? So, they are the perfect example about how you have this e-com native brand that transitioned into into brick and mortar. And it's something that you recognize because you bought them many times on Amazon before. One other example, which is very interesting, Revlon. Revlon was, the legacy brand that we all talk about. They have an item that the way they market it on shelves today is it's in a beautiful red box. It's got it's a brush with a hair blower in it, and front and center is 4.5 stars based on Amazon sales. Wow. And that's what they're selling in brick and mortar. So the strength of the visibility of online, not only Amazon, it could be like a direct to consumer site, but the fact that it's so visible and you can see these brands that are active and you can understand the values in their product, it really has created an opportunity for e-commerce brands to be able to capture the attention of the buyers who are now of age, that they're shopping in these channels and they're getting their information from those social channels as well.
Great. Joe, what do you have to add to that?
No, so Irv's making some great points, and that's really what we've seen with the retailers, a kind of understanding that it's a much bigger picture than it was a few years ago. Some of the challenges, though, that we've been running into, which is kind of interesting for you and Jack, is when we're speaking to these e-commerce native brands, they were running their entire business on a model that is based on Amazon distributing money, right? And helping their cash flow over every 2 weeks. And it's a totally different head when you're talking to them and saying, hey, if you got an order from TJ Maxx, or if you got an order from Walmart or Target, would you be able to finance this? And they look at you like you're absolutely crazy. They're like, no, of course we can't. We can't wait 60 days until we get paid. Like, it just doesn't work. So that also, I think, is kind of waking them up to the fact that, wait a minute, maybe I'm not fully financed. Maybe I'm not financed well enough. And that's something that we're seeing a lot, because there really is a lot of opportunity out there, but people are very in their own kind of tunnel vision, focused on the way they've done things. But when you open up their eyes to a bigger world, it's like, there are other ways to do this.
Right.
So that's interesting.
So it's a great segue to my next point that Richard brought up. If online merchants move to physical, how do I finance it? Now I'm going to let Jack's been so quiet. We're going to tell him how Daya or how a finance company could do that. So Jack, you're on.
So like Joe mentioned, the transition for some people is difficult because it's very foreign. If they're used to selling to a certain segment, that's what they know. And when you're moving from online to selling to retail via the wholesale channels, the cash needs and the demands are much greater. So factoring speeds up the cash flow, so the client is not waiting the 60 days or 90 days to collect from their customer any longer. And inventory facilities we've been putting in place for online merchants is also helping them increase the amount of capital in their business, so they could buy new product and sell it and scale their businesses and really meet their goals in a streamlined, efficient, cost-effective way.
Okay. I have a point on that I wanted to bring up, because it's people that we've been working with. A lot of the companies that we're negotiating with are what I call hybrids. They either had a strong wholesale model and they go to e-com, like Joey and Irving know, or they're in e-com and they go into brick and mortar. So the financing is sort of like a two-track financing. It's a different model. And a lot of people, like you say, some people in wholesale don't understand e-com financing. Some in e-com don't understand brick and mortar financing. So we do that. We clear the air on it. We show them the different models of financing that could be offered in the place to let them continue their growth in both sectors. To the other point I wanted to bring out that Richard is always has spoke about in the past. The other piece, the direct to consumer model. So Richard, maybe you could talk about a little bit about how that model plays in the world of, say, e-com or brick and mortar. How does DTC play a role? Do the DTC company open up stores? Just give us a little education about that.
Well, first of all, I want to comment on what Joe and Irv have done. I think their flexibility to pivot their business is so impressive. And that is one of the things that's necessary for success in the future, and that very few people can do. And the reason you guys are successful and are getting traction is exactly that. Very few people are able to turn on a dime the way you are. And turning on a dime comes also to what Jack and Irwin were saying, which is You have to turn on a dime to finance your inventory. Your financing cycle when you sell to Amazon is so different from your financing cycle when you sell to TJ Maxx or Macy's, whomever. And being able to adapt to that is critical to the survival of a business right now. And that gets me to your question, Erwin, about direct to consumer, because, and how do they sell? We used to think about channels. There are no more channels. It's not right to think about just as you could understand how a retailer who has stores in Chicago and Houston doesn't care if you buy their product in either of those stores. Likewise, you don't care if you have a product, whether people buy it online or in a store or by phone. It just doesn't matter. What you care about is that they buy it. And that means that all the channels need to work together. You don't care if you own a brand or a product. Whether someone comes into your store and buys the product on their mobile device while they're standing in your store, they all need to work together. And that changes the way in which your financing cycle works. It changes the way you market. It changes so many things about your business. But when you think about it in the old way of tunneling each different product into a different channel, then the consumers are not different. We all know that we all buy both in stores and online. And we do it at different times. We do it for different products. We do it in different moments and for different needs. Even the same product can be bought in different ways. And so it's a more unified approach. Direct to consumer, what does it mean? Well, it means exactly what the words say. It means selling from the maker through to the consumer without a retailer in between them. And that can be in a store, it can be online, it can be in a pop-up, it can be a million different ways. But what it also means is that there's an additional cost. It turns out retailers don't do nothing. They get the consumer to be aware of the product. And that has become what we now call customer acquisition cost, which is a very complicated and expensive mode to get to your consumer. And so everyone is trying different ways to get around that. And some of that is what Irv and Joe are doing, putting products in stores so that you can reduce your customer acquisition cost. Sorry to be so long-winded, but I think without taking a holistic view of how to communicate with your consumer about your product and awareness of your brand, it's so much harder to cut through the noise.
Great wrap up. Okay, I think we covered almost all, our agenda. I'd like to wrap up by something that we talked about just before we started the event, and we could start, let's say, from Richard to Joe to Irving. That I asked the question earlier, and to Jack as well. What's the latest news in retail? What should we be preparing for from every standpoint, from merchandising, from finance, from product, from channel, from distribution? What's your take?
I think the hardest thing to change now is culture. And the reason why I think Irv and Joe have been successful doing what they're doing, putting online products into stores, is because everybody else is so much slower than them. Why is that happening? Change creates anxiety. People don't want anxiety. And the world is changing very rapidly, and the people who can adapt will win. What does that mean when you have a company? It means that you have to move quickly, and everybody pays lip service to that idea. But the real challenge in that is in being able to look at the people that you respect and have done good work for you for many years in the past, but who can't adapt, and to make the changes you have to make. And that is very hard. It's emotionally hard, it's commercially hard, it's risky. But the people who are succeeding are the ones who are willing to change.
Thanks so much, Ruby. Joey, you're on.
It's a great point, Richard. Almost can't agree with you more. I've seen it, unfortunately, too often with people either in the community or just clients of mine that have called us over the last few months, having a very hard time with all the different things that are coming at them, whether it be if they're an Amazon seller or they were, very reliant on a particular retailer. So, and also, especially if you're your own importer or you're manufacturer and you've had all these issues over the last few months getting containers in, you cannot, in this day and age, be solely reliant on one thing, and you need to be nimble. And it's a very important thing, because you could literally today, much different than years ago, wake up and the thing that is driving your business can be changed in a minute. And if you're not on the ball and you don't have a pulse to what's going on, you could very easily, kind of get like shipwrecked. And I've seen it, unfortunately. I've seen it happen. And if you're not continuing to see what's next, and you're not making those small investments of time, money, and resources to prepare yourself for what's next, or to at least be ready to make a small adjustment or a small change, you're gonna get hurt, unfortunately. And there are people that are doing those things, right? That have the experience, that are learning new things. Just a small example. A few months ago, I heard about this whole NFT thing, right? Not to get so off topic, but it's a non-fungible token. I didn't know what the heck it was. And I very easily, and I really didn't. And I could very
Until you saw it was sold for $69 million, one coin.
Yeah. So you could have very easily said, whatever, I don't understand that, and I'm just going to keep doing what I'm doing. Do not do that these days, because if there's activity somewhere, or if there's a market somewhere, learn about it, understand it, so maybe you could apply your business to those things. Don't just have tunnel vision and say, I'm just going to do what I'm going to do. The most successful companies online right now and on Amazon are companies that have multi-channel distribution, whether it be all the marketplaces, their own website, potentially stores, potentially wholesale, retail. You need to be on the ball and see what's going to be next. That's the most important thing.
Great. All right, Irv, go for it.
So I'm going to jump on Joe and Richard's points, because I think you guys really nailed it on the head, is being nimble and making sure you're not relying on one particular avenue to get in. When we talk to a prospective client in Project Retail, we tell them that we have 4 main buckets that we go after. The top is we want a Walmart all-door buy, right? The next level down is, we'll take a regional test in store. The next level down, we want the buyer to buy the product online, right? And then that last step is drop shipping, right? Where they'll set us up as a drop ship vendor, which is the least favorable, right? So we're going down in descending order. And the reason why we lay it out to them is that you don't know where the opportunity is going to happen. And with that being said, you want to make sure that you have all your ducks in a row for any one of those opportunities, because you know what? You never know. If they're coming, if you get the Walmart buyer that calls you up and they say, look, I have no immediate opportunities right now. There could be an opportunity in 3 months from now. I want you to start drop shipping. If you can't drop ship, you lost that opportunity, right? You may be ready, EDI ready to go, that if they placed a $20 million order, you can ship it. But if you can't ship one piece to a customer in Nebraska, you lost that opportunity, right? So it's very important to kind of identify where those opportunities lie. Like, for example, you're an Amazon FBA business. If you're out of stock on one size and Amazon is not letting you fulfill because there's a restock limit, make sure you can turn on FBM to make sure that you're in stock on the medium, so your whole size run is available. I gave that example when it came to drop shipping, right? Make sure that your warehouse has the ability to integrate with the different providers out there that can talk to Walmart and Kohl's and the Target. So if you have that opportunity, you don't need to wait 6 months to be able to get set up in order to fulfill that opportunity. The last thing that I wanted to mention about, actually it just slipped my mind. Okay, but that's the moral of the story is just, okay, I remember what it was. Now there are more opportunities than ever with people having difficult times getting product into the States. With that being said, if you are not averse to carrying some inventory locally, that also creates opportunities. So it's the same way. If you might have been a company that in wholesale that did upfront to order business, consider balancing it with some stock opportunities that you can test should something present itself. So just making sure that you have all the boxes checked off for any opportunities that come up, because the world is changing like crazy. And if you are well positioned in all these different spaces, you could potentially catch something that your competitor would not.
Jack, anything you want to add to the financing piece? today's,
Well, just that I think there is a lot of opportunity and a lot of opportunity to, to shift from retail to online and back and forth. But they are different businesses, and when someone is making that transition, they really need to understand the differences in the markets, the difference in the infrastructure needed, the differences, financing is one part of it, but there are a lot of different differences, and it's very manageable and doable, but the entrepreneur needs to really understand them so he doesn't shoot himself in the foot by accident.
okay, great. Molly, we have a couple minutes left, running over time, but we have a couple minutes left for questions. If there's any questions, please shoot them out on the screen to Molly. Molly, anything on the screen?
Yeah, everyone could put their questions in the chat box or use the raise hand option and we'll unmute you to ask your question. Someone asked, is direct-to-consumer a growing segment versus retail distribution? And what's their statistics on the market share?
Good question. Rich, you want to take this one or you want me to jump in on that?
That's all you. Go ahead.
Well, I don't have any statistics on it, but yes, direct to consumer is growing, and the way you see that is the way in which they're chipping away at legacy third-party retailers' market shares. So, and we also see it in the numbers we see in the companies that are private that are direct to consumer. But as I was saying before, I think it's important how you define direct to consumer. We tend to think of those as online only. That's not really it. So, but direct to consumer is what consumers want because that allows them the identity and association that they were talking about before. And that's one of the challenges for multi-brand retail.
I think also from a risk level, I mean, not everyone has the ability to open up a retail store. And obviously, like I think Richard said earlier, it was a little funny. It's not easy to open up a retail store. We used to think that it's nothing. There's rent, there's people. I mean, I know a ton of warehouses and stores that can't even get workers right now. So don't rush to open up a retail store. But I think a good way to do it on in a way to limit your risk is to start online, to try to see if you can get an audience, doing it through Facebook ads or through through social posts and to run sales and things like that to see if there is a market first. There's definitely nothing wrong with direct to consumer, but I think that probably the easier way, the barrier to entry is probably through wholesale. If you can get a buyer to test your product, first of all, it gets the ball rolling, help with your minimums overseas and things like that to try to get your prices down. And then you could always slowly inch your way into building a direct to consumer brand. It doesn't have to be direct to consumer first and then to retail. It can be in retail first or online, and then you could slowly build your own avenues, through either a store or your own website.
All right. So you're saying you could go left to right or right to left with your product. If you're in a store, you could go online. You're online, you could go into a store. I didn't know that. I didn't know. I didn't think that. To me, it was like, if it's in a retail store, could you take a product in a retail store and put it online? Or it doesn't have that appeal because maybe the online market is a millennial market and they don't want old world merchandise. I'm just thinking baby boomer and putting on millennial hat,
It depends what store you're talking about, right? So, if you're going to place a product in a Walmart and then you're going to go online and try to attract a Nordstrom not quality, but a Nordstrom type of customer, I think is going to be no overlap. But if you're starting, in REI and then you're going to try to create an outdoor brand online, I think there's a closer parallel between what that consumer in store and online is looking for. And I think it's a very feasible and reasonable type of jump.
Right. Okay. Any other questions, Molly?
Yeah, someone asked, are there any specific categories that are gaining momentum now?
Great question.
So yeah, that's a good question. I'm going to jump in on that only because I have a lot of access to so many different sellers. Obviously, over the last year, home has become very important. I think a lot of people are either improving their home office or or they're just home more. And to be honest, with all the stimulus checks that are going around, I think people are trying to improve their home value. Real estate across the country, residential at least, has gone up in a big way. Obviously, like Richard said, commercial not so much, but definitely home. And I would also say sports and outdoors. What I've seen across the, really across the Amazon sellers that we work with is people are looking to do a little bit more active, either sports, or they're looking to go on more vacations, right? Because now that things have opened up a little bit, they're looking to do more activity. So, and always health and wellness is a big thing. Like that's just been carrying, and I don't think that's going anywhere. So to me, I think I would say between home improvement, sports and outdoors, and anything to do with health and wellness, those are very hot categories.
And then we have one last question. Are retailers accepting higher prices because of higher costs to import?
So it's a good question. I would say probably not so much, but what I've been seeing, particularly when we're talking from Project Retail's perspective, bringing strong e-commerce brands to brick and mortar, what there's been a willingness to do is, let's say there's a retailer that's always sold an item for $50, but we're showing an item with maybe a higher quality, more value, whereas in the past, if we tried to break that retail threshold, we've been unable to do that. Now we're finding that there's been more of a willingness to jump to another level for that higher quality item, especially when it comes to higher price points, because when you're at the higher price points, people are more likely to check on their phone. They check on Amazon and, they want to say, all right, I'm going to spend $80. Where can I buy this for? And they're seeing that if it's comparable on Amazon, or it might even be higher priced, the retailers are a little bit more open to bumping those retails up. So surprisingly, we've seen that recently over the past couple of months, that people I never thought would accept a particular level of price points, they've been more open to doing so.
As a general rule, pricing is about power. So if a retailer needs an item or a brand and they can't get it for less, they're going to pay a higher price. But where a product or a brand is a commodity, they're just going to play you off until they get to the lowest cost producer. And, and of course, if a brand needs a retailer, they're going to price to whatever the retailer says. So whoever has the power can, I wouldn't say name their price, but can fine tune their price. And more importantly, whoever has the power gets the margin.
I definitely have heard though, and again, some of them could be fake stories, because you know how people love to say, I'm getting more now for my item, but I have heard across a few categories that are more niche and seasonal, that the buyers are panicking that they aren't going to have goods for third and fourth quarter. And, because of all the delays in China, and they are willing to pay more and even bring goods in earlier to make sure that it's in their DC, as opposed to waiting for their manufacturers to deliver at the right time. So those are two things I think Irv and I have never seen before. A retailer, especially an off-price retailer, willing to pay a little bit more and to bring in goods early to make sure that their stores aren't empty and back to school in the fourth quarter. So yeah, we're definitely seeing things that we've never seen before. I don't know how long those things are going to continue, but I think as long as the as the supply chain issues continue with container costs and factories overseas being delayed with all different sorts of things, I think as long as those things are happening, you're going to see things you've never seen before.
We've also been hearing that from clients as well in some of certain categories where they've been working with their buyers and there's communications, and they've been willing to maybe not eat all the freight increases, but sharing it and, as part of the partnership. So we've been hearing that often.
You have anything else, Molly?
To piggyback off what you said, Joe, someone asked any insight into when you think the supply chain will sort itself out.
I wish I had the answer to that. I don't think, from what I'm seeing, again, with all the people that I speak to, the container costs have not been going down. I think it's a very simple thing. It's supply and demand. When there's a little less demand in the US for consumer products, and these freight forwarders and all the companies in China realize that they can't get $15,000, $17,000, $18,000 a container, it'll come down. But as long as they can, why would they lower the costs?
Right.
So I wish I had a better answer, but.
I might have the answer, not myself, but anybody who's on here, our next webinar, so as a good segue, in several weeks from now, which we'll let everybody know, is going to be about logistics. So we're going to have freight forwarding, we're going to have ship companies, we're going to have everybody that moves the stuff from overseas to here on to answer those questions on if the ships are going to go down in price, how fast they're going to come, should you use air freight, where should you go? So that's going to be the next webinar on, on how to get the goods here once you make them so hot that everybody wants them, but how are you going to find them? Any other questions, Molly?
Yeah, one last question. Someone said, do you anticipate off-price to continue the momentum that it has now?
That's a great question.
Everybody.
Everybody.
Yeah. It's an interesting conversation, Richard. Early on, you're talking about making that shopping transaction an experience, and I feel like, in their interesting way, the off-price guys have really managed to do that. In that, every time you walk in there, you got to act now, or it's not going to be there the next time you're there. And I think that's one of the reasons, you're walking in there, you're finding something unique each time. A lot of brands, you go to a Target shelf, the same item sits in that one spot. It kind of checks off the box, and that's all that there is. You go to off price, you're kind of surprised and delighted each time. So I don't know. We've been seeing a huge shift. We're seeing a lot of the retailers that we've worked with for years really starting to expand their store count even more so than before. I don't see it stopping anytime soon.
So the treasure hunt is still alive and well?
And I think they're even becoming more aggressive. From what I've been hearing, they're giving up fronts where they used to not give up fronts. They're afraid that they're not going to have goods. Anyone that knows off price knows the type of turns that these retailers work on. So they work on 1 to 2, potentially even 3-week turns. Think about how much product they need. And if there actually is a slowdown in production and people can't get goods, they're going to be very hungry. So I think I don't see a slowdown at all over the next 6 months to a year at off price, because really the department store level, one level up from them, has all disappeared. So it's off price, it's mass, really it. So
There's always going to be a shopper who shops by price. And we can talk all we want about values and association, but there'll always be that consumer who says, I just want the cheapest one. And it's not even a consumer. We all do that at certain times for certain products. And so I think if you're a product supplier, that business is going to be there for a long time and the prospects are good. But if you're in that business, that's less interesting because it's become so competitive. Joe mentioned a moment ago about department stores going away. The department stores have really gotten into the price business. And now with all the shipping issues that you're about to tackle in your next program, Erwin, it's harder for those businesses to get goods. And that's why Irv and Joe are seeing the kinds of commitments that they were never able to get before. So if you're in the off-price business where you have more square feet competing against you than ever before, and fewer goods that are available, and less commitment because of risk avoidance to making goods that could wind up in surplus, it's a way more challenging time to be in that business.
All right, great point.
definitely.
Anything else, Molly?
We have someone raising their hand. I'm going to unmute them so they could ask a question.
Go ahead, go for it. Go live.
Hi, Robert.
Here?
I think we might have lost him. No, that's it.
That's it? We're good? All right, guys. We went over, which is great news. Tremendous amount of information. Richard, as always, thanks. Joey, Irving, Dynamite, Jack.
Great to be with you.
Molly's our producer, so let's give a big shout out for Molly. And please, we'll be sending out this, correct me, Molly. We'll be sending this out as a replay, right, Molly, as a video, so you could watch it or give it out to other people. We'll also be sending a survey about what we're doing. Please reach out to any of the panelists. Everybody's, is a trailblazer in their field. Richard, in his world of, investment banking, M&A, is awesome. Joey's on it in the world of Amazon and merchandise. Irv's got this project retail with Joey that really is cutting edge. And Jack is, when is the banker. So when you need the money, Jack's there. I want to thank everybody. Please answer the surveys. Tell us what you're looking for. We want to make this interactive. We want to grow this thing. It's going to be a 4-part series. And after that, the big surprise is right after the summer, hopefully we're going to go live in New York, and we're going to step it up with networking events and a lot of good things. So everybody stay safe and be well. And thanks a lot. Have a great day. Bye,
Thanks.
guys.
Bye.
Bye.